this is a big consideration. The central bank digital currency, abbreviated CBDC, is being explored by 130 countries, representing really 98% of global GDP, gross domestic product. As of the end of 2021, there were about a dozen CBDCs that have already been launched, in the world. 17 are in the pilot stage, and 72 are in research and development. 19 of the G20 countries are now in the advanced stage of the central bank digital currency development. That's quite significant. 19 of the 20 countries in the um, in what they call the G20, the nations of the world. 19 of the 20 are now in an advanced stage of developing this digital currency. The United States is the notable exception to that particular trend. The Federal Reserve is continuing its ongoing digital currency research, experimentation, and evaluation. And there is a Treasury led interagency working group that's being created to support the Federal Reserve efforts. Um, it's interesting to note that one country, India, has already issued a note, concept note on the central bank digital currency. The By the end of 2021, of the nations that have been earlier mentioned, um, 12, have already launched their form of currency. Seven, and a number have issued or launched a pilot project. The majority of the countries, um, their stage of development is really still in the research and development stage. The As earlier mentioned, while there are technological advantages to the digital currency, the there are uh, um, challenges, you might say, and dangers to the implementation. Um, Nobody wants to follow in the lead of China that has been very, very much progressed and at a progressed stage of development of a CDBC, because they have acknowledged openly that they use their form of digital currency as a way to, basically track the transactions and the movements of their citizens. And they, at a federal level, are able to either approve or disapprove of these decisions made by their citizens, which in effect um, lead to controlling the financial life of their citizens. We don't want that to happen in this country, and to establish that as the general rule, our United States House of Representatives have passed a bill barring the Federal Reserve from issuing a digital dollar. The and that occurred back in May 23rd of this year. But the bill The House representatives passed a bill. That bill it barred um, or prohibited the Federal Reserve from issuing a central bank digital currency unless it has explicit authorization from Congress. For those of you in the listening audience that would like more information, more detail on that bill, and bills that have actually passed the state legislatures in other states. This reporter will be happy to bring you up to date on the on the states that are speaking out and passing legislation prohibiting the issuance of a digital dollar in this country. So we'll keep you up to date on that. Um, the the digital asset market really has grown quite a bit in the past few years. Millions of people globally, including 16% of adult Americans, have purchased digital assets. Um, and that's not the digital dollar, but this is speaking generally when I mention digital assets. the Back on March 9th of 2022, President Biden issued an executive order titled Ensuring Responsible Development of Digital Assets. And in that executive order, he outlined the first whole of government approach to addressing the risk and harnessing the potential benefits of digital assets and their underlying technology. Just since then, he has set up an executive office as the leadership organization in the federal government, and they have been tasked with working together to develop frameworks and recommendations that advance the 6 key priorities identified in the executive order. What are those? Consumer and investor protection, promoting financial stability, countering illicit finance, U.S. leadership in the global financial system, economic competitiveness, financial inclusion, and responsible innovations. The 9 reports have been submitted to the president to date, consistent with the executive office deadlines, and reflects the input and expertise of diverse stakeholders across government, academia, and civil society. Recognizing the potential benefits and the risk of a central bank digital currency, the reports encourage the Federal Reserve to continue its ongoing CBDC research, experimentation, and evaluation, and call for the creation of a Treasury-led interagency working group to support the Federal Reserve's efforts. As I mentioned, the digital assets do pose meaningful risk for consumers, investors, and businesses. Prices of these assets can be highly volatile. The current global market capitalization of cryptocurrency is approximately 1/3 of its November 2021 peak. Still, sellers commonly mislead consumers about digital assets features and expected returns. And there's been non-compliance with applicable laws and regulations that remains widespread. One study found that almost a quarter of the digital coin offerings had disclosure or transparency problems. For example, like plagiarized documents or false promises of guaranteed returns. Other things such as outright fraud, scams, and theft in digital asset markets are on the rise, according to FBI statistics, who reported monetary losses from digital asset scams were nearly 600% higher in 2021 than the year before. While I would agree that traditional resource finances leave too many behind, and the reports show that roughly 7 million Americans have no bank account at all. Another 24 million rely on costly non-bank services like check cashing and money orders for everyday needs. But I would presume, and I can't be, absolutely certain, but I must presume that many of those folks who have no bank account may be in the population of the country that has come to the United States under suspect credentials or having just crossed the border illegally. And there may be someone in the government who are looking out, for the needs of some of the individuals who do not have citizenship in this country. In any case, this area will be continued to be followed by this reporter. The area that I'd like to just focus on again, because as we get closer and closer to 1930, or rather 2033, there is a looming Social Security insolvency that we face in approximately 8 years, and that's Social Security. There's a huge number of issues that have to be addressed by the new administration, and along the long list of issues that are needing attention, we find Social Security reform. This is a major issue, and it's made more urgent by its trajectory toward a major financial catastrophe for tens of millions of Americans. Most of us are aware of the Social Security Administration's oft-mentioned warnings of impending insolvency. Now that insolvency is projected to be a reality, as they say, in about 7 to 8 years. Insolvency, of course, translates to the program being unable to meet its benefit obligations and a forced 21% across the board reduction in benefits. So they're predicting if that day arrives and the Social Security program is declared insolvent, by law, there's going to be a 21% reduction across the board on all beneficiaries. What would that do to your individual family budget? The program's trustees have been sounding that alarm for decades, with each annual report to Congress projecting the point of complete exhaustion for its financial reserves. A lot of sources are adding their voices to the call for action, emphasizing that the closer we get to the loss of financial reserves, the more difficult and more disruptive corrective action will be. Insolvency is not a self-correcting problem, and it's a given that delaying action on financial problems of this magnitude tends to make them worse. So why do we have this Social Security insolvency problem? Well, it's worthwhile looking backward to see how we actually got here. The inability to meet Social Security, inability to meet their obligations, that's been going on for a long time, really. Since 2010, the main source of Social Security revenue, which has been the payroll tax, that's fallen short of the benefits being paid. And that's forced the administrators to rely on interest on reserves, and then revenue from income taxes on benefits to make up the difference. So two of the main sources of income to pay out the benefits have been the payroll tax, and then interest on the reserves, and then third, income from income taxes on the benefits. Beginning in 2021, scheduled benefits exceeded even these three revenue sources, and that caused the administration to begin eliminating, or liquidating rather, the reserves that had accumulated over the past 40 years. That's the technical part of the problem. A Social Security insolvency can generally be attributed to three primary causal areas. First, increased life expectancy, as we all are quite aware. They're causing Social Security to pay benefits far longer than anticipated when the program was originally enacted in the 1940s. Second, the ratio of taxpayers to beneficiaries, that ratio, it's just fallen dramatically. And back in the 1940s, it was about 42 taxpayers, were supporting one beneficiary, and that was as I mentioned, in the 1940s. Now it's dropped. The number of taxpayers supporting one beneficiary, it's dropped from 42 down to less than 3. It's actually 2.7. So it's a huge change in that ratio of paying taxpayers to receiving beneficiaries. The second, and then they're saying that ratio has really changed. The major, I'd say, the major contributory causal causation has been increased life expectancies, paying out benefits far longer, far more a year than originally anticipated. Second, the ratio of taxpayers to beneficiaries going from 42 down to less than 3 this year. And finally, the third major causation is the distribution of the workforce earnings. That has changed dramatically to the point that there's a greater portion of the taxable wages are somehow escaping the payroll taxation. So those are things that are really causing the problem to fester. Now, without any legislative intervention, that change would be abrupt and it would be a calamitous for millions who depend on the program to remain above the poverty line. Every year, we've got legislative proposals that are introduced in Congress to adjust specific segments of what's a very, very complex program when you come right to them. But virtually none of these actually make it into the formal law. And I'm sure you'll have the same experience this analyst has had when attempting to get a comprehensive understanding of how that the Social Security program works. It is very, very complicated. There are various approaches. This morning, we're actually highlighting an approach, from the AMAC organization, which is a senior political group that publishes a magazine and updates on a regular basis. What they are recommending, they're recommending that some approaches to the Social Security financial deprivation and oncoming bankruptcy, basically. There's some specific principles that they are hoping that the solution will cover. The first one is guaranteeing an annual increase in benefits for all, with emphasis on those with lower earnings, and to ensure that the program actually stays true to its mission of keeping seniors out of poverty. The second major mission is to guarantee solvency and ensuring benefits continue without any automatic cuts. Those automatic cuts can be absolutely devastating. And then the third major mission is to guarantee all earners the opportunity to create more income that would be available at retirement through work and improved retirement savings programs. So we'll try to keep you up to date on what programs might be coming down the pike that will help you. A question that has been posed concerning Social Security the question is, are your Social Security payments, do they actually include repayment of the contribution that you make, when you are when you're making your contributions through the tax structure? Well, the response is that it's not how Social Security really works. The money that you contribute to Social Security during your working years really does not go into a special account to be repaid to you. Rather, the Social Security taxes you pay while working, they're used to pay benefits to all those currently receiving Social Security. And the system really is, in effect, the pay-as-you-go program, where all those currently contributing help pay benefits for all those who are currently receiving benefits. What your contributions do, however, is to earn your quarter credits. So, this based on the number of credits that you have. When you have enough credits, you become eligible for Social Security retirement benefits for life. Generally, you need to contribute to Social Security up to about 40 quarters, that is approximately 10 years, to be eligible for Social Security benefits. And again, I mentioned that you need to have about 40 quarters, approximately 10 years, to be eligible for Social Security retirement benefits. Now, how much you receive monthly is determined not by how much you actually contribute, but really how much your work earnings were over your lifetime. You'll get a percentage of your average pre-retirement work income as your monthly Social Security payment, but that is also affected by your age when you claim the benefits. It is your average lifetime earnings adjusted for inflation that actually determines your PIA. That's your primary insurance amount. Your primary insurance amount is really what you get at your Social Security full retirement age. That's abbreviated FRA. And that's the age when you claim benefits in large part determines if you get more or less than your primary insurance amount. Claiming Social Security before your full retirement age means a smaller monthly benefit, but waiting longer than your full retirement age means the benefit that will be higher than your PIA, your primary insurance amount. So each person's a person's full retirement age is different. That's basically on the year they were born. But full retirement today is between 66 and 67. That's when you establish your full retirement age. When you claim benefits relative to your full retirement age, that determines how much of your primary insurance benefit you will receive each month. So your contributions to Social Security really are not used to determine your monthly benefit amount, but your average lifetime work earnings and age when you claim those are the determinants. Your average lifetime work earnings and your age at the time you make a claim. Nevertheless, you may be interested to know that most people get back everything they personally contribute to Social Security within about 3 to 5 years of collecting their benefits. I'll repeat that again. Most folks get back everything they personally contributed to Social Security within about 3 to 5 years of collecting their benefits. Now, in that sense, Social Security is an exceptionally great deal since most Americans now collect benefits for about 2 decades. That's about, 20 years? And therein lies much of Social Security's financial dilemma. People are now collecting benefits for many more years than the current program is designed to support. And that is what Congress really needs to fix as soon as possible. The Social Security Trust Fund, which now provides supplemental money to pay benefits, they're projected to be depleted around 2033, around 8 years off. That will mean a cut in everyone's monthly Social Security payment unless Congress acts soon to reform the program and restore it to fiscal solvency. And that includes more and more people as we go along, and certainly going to include, a growing body of recipients, particularly with the migration patterns, that we've experienced over the past few years from both the southern hemisphere of America and the rest of the world. So, and with that, we will switch over to taking a look at what you should be aware of, since we are only, as I mentioned, 3 weeks away from the end of the year and 3 weeks away, or approximately 7 weeks away from the actual um, tax filing season for a tax year 2024. And we hope that this program will help prepare you, at least mentally um, and attitudinally, for preparing for a really topsy-turvy tax filing season, because the as a result of the election this past November, there's going to be quite a tax year to deal with all of the 2017 tax upgrades that took place during Donald Trump's term. But many, but not all, and keep in mind that not all, but many of those upgrades are going to have to be dealt with, because they were set up by law to expire at the end of this next year, at the end of 2025. So they're going to have to do something with those changes that were made. And granted, there were huge changes in the child tax credit, huge changes in the deduction of property taxes, huge changes in the treatment of miscellaneous itemized deductions by self-employed individuals, which were limited, which had to meet a threshold of 2% of your AGI. I know of a good number of taxpayers who are still keeping track of their records based on the former possibility of deducting a lot of expenses that have been basically withdrawn and repealed back in 2017. So hopefully those individuals will become educated and updated on the things that can be deducted and those that cannot. Certainly the miscellaneous itemized deductions are taken on the Schedule A. Those deductions have been repealed since the 2017 Tax Act under President Donald Trump. Okay, so and we'll share with you some things that you might, which may help you, hopefully, either increase your refund or cut down on your tax bill. Okay, if you earn income from rental properties, you may be eligible to claim a nice tax break, the 20% qualified business income deduction. It's called the QBI. QBI deduction is for self-employed individuals and owners of pass-through entities such as LLCs, partnerships, and S corporations. Those individuals can deduct 20% of their qualified business income. The write-off also applies to some landlords with Schedule E rental income. So, in addition to the Schedule C filers, it can also, under certain circumstances, apply to Schedule E filers, which Schedule E covers the rental income. There's lots of special rules and restrictions, many of which apply to people with taxable incomes before the QBI deduction of more than $383,900 on joint returns. So that basically, is the threshold. And there are a good number of rules and restrictions that would prevent you from taking that QBI deduction if your income is more than these threshold amounts. The threshold amounts for joint filers is $383,900, for joint filers. And for all other returns, the threshold is $191,950. The write-off is temporary. It ends after 2025. So unless it ends unless Congress extends it. So there will be an absolute huge flurry of tax activity in the U.S. Congress to either permanently repeal those changes and upgrades made in 2017, or to up or to to extend the upgrades that were made in 2018 for the 2017 tax year. So there's two ways to qualify for the 20% QBI write-off for rental income. The first is rental income automatically, if the rental income rises to the level of a trade or business, then you'll be able to, that's one way to automatically qualify to take that 20% QBI deduction. For this purpose, that is for rising to the level of a trade or business, the regulations refer to the standard under Tax Code Section 162. That statute generally governs the deductibility of trade or business expenses. Now, there's no statutory or regulatory definition of a Section 172 trade or business. Instead, this determination is based on the taxpayer's specific facts and circumstances. You'll hear this many times in the future. And it's based on the specific facts and circumstances, very individualized. Some relevant factors are the type of property, either commercial or residential, the terms of the lease, extent of day-to-day involvement by the lessor or his or her agents, the significance and type of ancillary services provided under the lease, and the number of rentals. So these are some of the areas of specific facts and circumstances. I'll repeat those again: type of property, whether it's commercial or residential, the terms of the lease, extent of day-to-day involvement by the lessor or his or her agents, by the person who's leasing the property, by the person who is actually the lessor. Another one is the significance and type of services provided under the lease, and the number of rentals. Some of the best practices to treat your rental as a business: keep expense receipts, ensure the realty that you're leasing, keep separate bank accounts, and track time and services performed. Again, keep receipts, make sure it's insured, keep separate bank accounts, and then track the time and the services that are performed. A second way to qualify rental income as qualified QBI is to meet a safe harbor. And that safe harbor is at least 250 hours must be devoted to the rental activity by the taxpayer, 250 hours a year. But it must be devoted by the taxpayer or the employee or independent contractor in a year. Time spent on tenant services such as repairs, property management, advertising, collecting rents, negotiating leases, and supervising worker counts. Hours put in driving to and from the property, arranging financing, constructing long-term capital improvements. By the way, it turns out to be something that cannot be included. The things that cannot be included are hours put in for driving to and from the property, arranging financing, and constructing long-term capital improvements. Those are not included, but things that are included, right? The actual activity, the time you spend, um, that on tenant actual services, time, the repairs, and the actual money repairs, the property management, advertising expenses, collecting rents, negotiating leases, and supervising workers. That counts. However, the things that do not count are the hours that you put in driving to and from the property, hours arranging financing, hours constructing long-term capital improvements. They are not included. If you own multiple properties, you can treat each property separately or aggregate similar rental activities into commercial or residential categories. Those who use this safe harbor must keep strict record-keeping requirements and attach an annual statement to the returns as detailed in Revenue Procedures 2019-38. You have to keep contemporaneous records, dates, descriptions of the services, and who performed them, in case they have to, in case you come upon an audit. If the services are done by contractors or employees, the taxpayers must keep logs of the work done by them as well as proof of payment. So it's it's something that is one way to, what you might say, secure that deduction. The for your general information, if you earn income from rental properties, if you just keep in mind that you may be eligible to take this QBI deduction, qualified business income deduction. Okay, well, and now that we've passed now that we have completed the election, at one time, the questions had to do with both Harris and Donald Trump's proposals for startup businesses. And the questions were posed: well, how does Harris's proposals, Kamala Harris's proposals, measure up to and compared to Donald Trump's proposals? Well, now that we've clarified which proposals are actually going to be considered by the Congress, we're now looking strictly at Donald Trump's proposals. Expense and there has been a lot of consideration of these new startup companies, which have just exploded, particularly because we've been living in inflationary times. Expenses in the startup phases of a business really are not currently deductible right away. You just can't, if you're in the startup phase, you can't just presume that the expenses are going to be deductible. It could, but you have to check. Firms can elect to write off up to $5,000 currently of such costs in the first year that they actively engage in business. But currently, you can only write off up to $5,000 of those costs. In the first year that you're considered to be actively engaged in the business, and you have to amortize the rest of the business expenses. What is the amortization? Well, generally, those are the expenses that you write off over 180 months. Basically, that's about 15 years. The $5,000, initial $5,000, phases out dollar for dollar once the total cost tops $50,000. So once your total cost is $50,000, you're not able to do any more amortization. The Harris wanted to increase that first year startup deduction to $50,000. But since she's lost the election, she will not be making the proposals to the congressional Congress body in the year 2025. What is interesting, where does the candidate, the successful candidate Donald Trump, stand? On where does he stand on the $10,000 SALT deduction cap? That is the state and local income tax limitation. That has been the subject of many state legislatures' actions to try to get them on that limitation of $10,000 on the Schedule A. But if, of course, nothing is done to update that limitation, the limitation will simply disappear, and itemizers in the wealthier states of our country, California, New Jersey, New York, New Hampshire, they're going to be jumping for joy because they'll be able to deduct the property taxes, the state and local taxes, with no limitation on their Schedule A. So after 25, unless Congress acts, itemizers would again be able to fully write off the state and local taxes as they generally could prior to 2018. Trump, however, he has floated the idea of actually axing that cap entirely, but we don't know just how serious this idea is. Given that the $10,000 limit was enacted in his late 2017 Tax Cuts and Jobs Act. Many of Trump's policy advisors oppose any increase to that $10,000 figure and are instead urging him to lower the cap or eliminate the deduction altogether. He recently vowed on social media and at a recent rally to restore that SALT write-off, saying the people in New Jersey, New York, Pennsylvania, and other high-tax states would save lots in taxes. Two things that you might want to consider: eliminating that $10,000 SALT write-off limitation would disproportionately benefit, of course, upper income folks. It would also cost the government a lot of money that the future president and Congress could use for other, tax cuts. There will be a great deal of activity once the Congress reconvenes this year, particularly the House of Representatives. And one thing that you should be aware of, that there has been action taken to increase the threshold amount for folks, self-employed people who get a 1099-K form. It's a 1099-K form, and those filings at 1099-K. That is for third-party settlement networks such as PayPal, Venmo, Etsy, and Square. Those third-party payment networks send out 1099-Ks to folks who are paid more than $600 a year for goods and services. Well, the prior law required 1099-K forms to be sent only to payees with more than 200 transactions who were actually also paid over $20,000. But there was a change in 2021, and that delayed it. Right now, IRS is now indicating that the 2024 1099-K forms will be sent out. That's going to be in 2025, this coming year. That's going to have a $5,000 reporting threshold, and not that original threshold amount, of just $600 a year, or the 20,000 a year from 200 transactions. Now it's going to be a change, from what I understand, to a 5,000 reporting threshold for those settlement networks such as PayPal, Venmo, Etsy, and Square, maybe for 2025. And as I mentioned, the House proposal would revive the old filing requirements of over 200 transactions and over $20,000 in amounts paid to self-employed individuals. And I might add that because that has threshold has been changed back and forth, would be wise to stay in touch with your tax practitioner or CPA to make certain that you are filing the forms, and to make certain that the forms that you're receiving are going to be necessary to also file with IRS. Are you thinking about installing an electric vehicle charger in your main home? Well, you can get a tax credit thanks to the 2022 Inflation Reduction Act that extended through 2032 a non-refundable tax credit equal to 30% of the cost of equipment and installation of a electric vehicle home charger, or $1,000, whichever is smaller. Businesses will get a bigger credit, and that would be generally equal to about 6% of the cost, or 30% if certain project requirements are met, or $100,000 per electric vehicle charger. You would need to use IRS Form 8911 to calculate the credit. And just from this practitioner's experience, you need to stay close in touch with your tax preparer in claiming these electric vehicle credits because of the complexity in filing. Keep in mind that IRS has recently delayed the expanding reporting rules for digital assets. The statutory change defining cash more broadly, that was a change to include digital assets. And you'll note that with each passing year, these questions about digital asset transactions are becoming more and more in-depth and more insistent with each new tax year that comes our way. This past summer, as you know, IRS sent out thousands of letters denying ERC employee retention credit refunds to employers And as you know, there was a high degree of fraud in that program. You know, it was related to the COVID-19 payroll tax tax break, but it was designed for eligible businesses whose operations were fully or partially halted, you know, or whose gross receipts fell significantly during the height of the pandemic. You know, employers have been swamping IRS with Form 941X filings looking for refunds for prior year employment taxes that they paid and any excess refundable credits. Unfortunately, a significant number of these claims had the potential for errors, and according to IRS, the ERC programs was rife with fraud and in major part due to unscrupulous and aggressive promoters and the complexity of the law. So employers who receive IRS letter 105-C can agree with it or dispute it. Those that agree with the disallowance, they don't need to do anything. It's gone. Those who don't agree have a few options. They can send additional documentation supporting their eligibility for the credit, but they have to send it to IRS within 30 days of the date of the letter. Or they can appeal to the IRS's Independent Office of Appeals within 2 years of the letter, again, provided they do so within 2 years of the date shown on the letter 105-C. And good luck with those with those letters. So, folks, we're getting close to the end of this week's presentation. But I can guarantee that the new presidential winner, he wants to make those tax cuts in his 2017 law permanent and to take it even further with lower federal income tax rates for individuals. So that's going to be uppermost in Mr. Trump's approaches to tax updates of the 2017 law. He does also propose to make some changes in the long-term capital gains. First, his plan calls for a 15% top long-term capital tax rate. It also supports the idea of indexing. This is sort of not a totally new idea, but it supports the idea of indexing capital gains for inflation each year. Essentially, if this concept was enacted, taxpayers could increase their tax basis, increase that tax basis, which is highly important. But they could increase that tax basis in capital assets by the rate of inflation between the purchase date and the time of sale. Let's give you an example. Say you bought stock in early 2010 for $10,000 and then sold it in January 2024 for $35,000. Now, without indexing, you'd have a $25,000 long-term capital gain. That would be $35,000 minus $10,000. The basis. With indexing, using the chained CPI-U inflation measure, your basis would jump to $13,714, and that would reduce your capital gain to $21,250 as opposed to $25,000. So that would lower that tax bill by quite a bit. Now, the idea sounds simple, but believe it or not, there's lots of complexities involved. So stay close and stay in touch with your tax preparer. Trump was all over the map on capital gains indexing during his presidency. He first touted the idea, and then Nixon. So we really aren't certain of where he stands on this now. So I think at this point, this presenter has completed this week's presentation, and look forward to next week's presentation, which is getting closer and closer to that dreaded day, or dreaded time, tax filing for tax year 2024.
Man, you mean it's coming around that quickly again?
It sure is.
You know, those are 2 days of the year that I hate, Eb. You know which 2 days they are?
That's right.
Tax time and Halloween.
Halloween.
Yeah. Thank you so much for the valuable information that you bring to this network each and every week. And folks, check him out next Thursday. Next Thursday, same time, 10 a.m. on the West, 1 p.m. on the East. Now, keep it locked all day for great music. And tonight, I'll be back with Cultural Excellence at 5:15 p.m. on the West Coast, 8:15 on the East. Yours truly, WB, signing out along with my friend Everett James. Good day, y'all.